Welcome back to Lamb's Cryptoverse. So today we're going to discuss analyzing altcoin projects in terms of valuation by using price to sales, also called price to revenue. So let's get started. So crypto projects must be analyzed like a three-legged stool. You need a holistic transversal approach. And I talked about this before, so I'll talk about it now quickly. First of all, you need to look at macro factors. What's happening here? What's happening there across the world? What's happening with banks, Silicon Valley Group, Silvergate, Signature, First Republic? All that comes into play. What's going on with the liquidity, inflation? Then you need to also look at fundamentals of that project. And there are many fundamentals. I'd say I have at least 24 factors that I look at when analyzing a crypto project. And some of these factors include the founding team, funding, what's their treasury like, for example, tokenomics. And lastly, but not least, I look at technical analysis. And I don't focus on this too much because 99% of the people out there focus on charts and technical analysis. So I think you get enough of that from them. So trying to determine a price to sales ratio or value. So what are the key issues? Well, first of all, you need to consider are layers 0, 1, 2, and depths, are they different from each other? I don't know. My feeling is that at least for now, that the lower numbered layers, 0, layer 1, these are like the operating system of Web3, of the internet. So I think right now there's going to be more value with those. But maybe, perhaps in a few years, there will be a killer app that becomes really, really popular. But right now, I think we should be focusing on those lower layers like layer 0, like Polkadot, Cosmos, Avalanche, and so on, and layer 1. So other issues, if tokens aren't securities, then what are they? And the reason I'm asking that question is that affects what they're valued like. Like if they have voting power, like a security, like a stock, right? If you own shares of General Electric, you have a voting right. You even have a preference in terms of the company going bankrupt. You have some kind of ownership. It's not first ownership. That would be if you have bank debt or something similar, or you're a supplier, or maybe something similar to that. Or maybe you're a bond holder, like a corporate bond, and you have some seniority. But what's the seniority if you own a token? Not much, right? So maybe they're valued less. And there's a lack of third-party data. And even if there is, we don't know if it's accurate. And then there's a lot of fraud and manipulation of that data. So there's a lot to consider. So now if you're determining the valuation, or you're determining the value of a company, of a token project, you need to consider how risky is it. We already talked about it in the previous slide, that it seems like, actually more than seems, it is riskier than a common stock. And it's riskier even than a high yield stock. So then if we just focus on tokens and coins, then within that sandbox, that cohort of those cryptos, we need to consider if they're low risk or high risk. And I did a video on modern portfolio theory that talked about how to analyze these coins using modern portfolio theory, and what I'm trying to think here, what we need to consider to determine if they're risky or not. So if they're low risk, they tend to be a top 10 coin. They have a lot of liquidity. That means you could buy and sell without manipulating the price. Also, the price is less. There's less ability to manipulate those prices to begin with. And they also have a good treasury. They have a strong following. Cardano, for example, has a very strong following. Those are lower risk tokens. And then you have higher risk tokens, which is like everything else. That's why I put here 9,000 coins. They have small networks, little funding, and it goes on and on. There's a lot of risk. A lot of them, by the way, have low transparency. You cannot even find anything on some of these coins outside of a white paper. That's for another day. So for this study, we're just going to focus on layer 0, layer 1, layer 2, some apps, some dApps. So our assumptions. We're using a more conservative definition of revenues. And Token Terminal calls these token buybacks. So what revenues are being used to buy back tokens, almost like a share buyback of a common stock. And we're using a more liberal approach, a less conservative approach for market cap. We're using circulating market cap because diluted market cap, which is also shown, fully diluted market cap, may be 10, 20 years out. That's a long time, probably 10 years out. And we don't know what the vesting schedules are, when we're looking at them as a group. And lastly, we were excluding stablecoins. So now that we know what the assumptions are, how risky they are, how should we benchmark crypto? Well, I already said that they're risky and they're more volatile. So just think about that. And they're growing quickly. So maybe they should have a higher price to sales than the S&P. So what is the S&P price to sales? It's over 2 times, which to me is pretty high. I think given that there's a compression of the P ratio as interest rates go up and a possibility of a recession, I would have expected the price to sales ratio to be below 1.7, which is the average for this year, but it's not. So should we value cryptos at S&P? I would say they should be higher, maybe like SaaS companies, software as a service, also known as cloud software. And here's a benchmark. There's several ways of looking at this. I chose the one that gives the highest price to sales ratio. And by that is I chose the price to sales ratio. In this case, it's enterprise value to the next 12 months sales, which is similar. And I chose compound annual growth rate of greater than 30%. So this is the cohort, the group of cloud software companies that are growing quickly. And why did I choose that rather than a typical average or slower grower ones? Because we're in the early stages, obviously, for crypto and blockchain. And so I think they're going to have rapid growth. So this is going to be the benchmark, I would say, that's closest to blockchain projects. And if you look at the red line, there's a 5-year trailing average of 17 times. Now you have to remember this 5-year trailing average was in a period of very high liquidity. So you really can't use that. And today we have a EV to sales ratio of 9.4. So let's just call it around 10 to keep it even. So that's 10. And I'm thinking maybe that's a good number. I'm thinking out loud here because if you go back to 2014, 15, 16, it was even lower. So I don't know, maybe the benchmark should be between 8 and 10. But the point is it should be higher than the S&P 500. And so maybe it should be between 8 and 10. So let's use that as the benchmark. Before I go on, I want to talk to you a little about the dot-com era, internet companies, IPOs, work done by the infamous Jay Ritter. If you don't know who Jay Ritter is out of University of Florida, he is very good. He is the guy, the dude that covers IPOs. He covers everything about IPOs, and I'm going to show you some data on the next slide. But this slide here, it's from Berkeley Business School. It talks about how internet companies, dot-coms, were valued back in the bubble era of 98 through early 2000. And I know this is difficult to follow. And this is just basically from a quant report. They did some statistics, and you don't need to know these numbers, but I just put them here so you can look at them at your leisure. The point is that the factors associated with valuation at this early stage for internet companies had to do with page views, number of visitors. If you remember, if you're old enough to remember, they talked about eyeballs, right? People that I should say companies that got people's eyeballs. They got people to look at their websites. They're the ones that are popular. They're the ones whose stock prices went up. They're the ones who had high valuations. And I still think that's where we are at this point in time for blockchain projects. So keep that in mind, because I'm going to have to show you a slide on actual price to sales ratio. And we're going to go back to this. And I promised you I would talk to you about Jay Ritter's research. And there's a few things I want to talk about here. Number one, everything's cyclical. And by that is you're going to see on these columns here. Let's just look at column one, but you can look at all these columns on your own. Number of tech IPOs. There are more IPOs when the market's hot, when the stock market's going up, when the NASDAQ's going up. This just makes common sense, right? It just makes sense. Proceeds, same thing. Proceeds are higher. They're higher when the market's going up and when the companies are valued more. Then you've got the median price to sales ratio. Now, this is something I really want to talk to you about. You have very high price to sales ratios when the market is topping. And you could see there was some stratospheric, crazy price to sales ratios for these internet companies. So maybe at the next bubble, not now, but the next bubble, maybe some of these crypto projects could be worth more. Are they worth what the internet companies were worth back in 1999 and 2000? No way. We're in a tight liquidity regime when valuations for everything, and it's not just crypto, everything, those valuations go down. And then this goes on and on. But I want to focus to you on something else. The columns on the right, yes, these companies don't have profits, but the median age, that's important, because here's the way I think of cloud companies, especially, and crypto projects. These have long business models. What I mean is these are like long duration assets. And these business models, the way they're created, especially since they were created during bubble times with lots of liquidity, the business models are created so that they don't scale up in terms of revenues, not for a long period of time. So just keep that in mind. And if you look at median age, when the market is weak and is low liquidity, the age tends to be lower. I think I reversed it. The age has a few factors. This is the median age before they've gone public. So in a bear market, the age tends to be longer. In the bull market, they tend to go public earlier. And that's what we saw with crypto blockchains, because they went public, ICO. They had initial coin offerings during a hot market. But my point is, so there's actually 2 points within the same column. Now, my point is, number one, you get younger companies and crypto projects going public when liquidity is high. The second issue is companies are not really, they're like wine. They don't get ready to go public. They're not primed to go public until the wine vintages are out there for a few years. So these companies need to ferment, and those business models need to scale up and grow. You need to build up the back offices. You have, let's just talk about crypto projects. You need to get hire developers. Those developers need to build the dApps. And before that, I should have said that those dApps cannot even go on a layer zeros and ones unless the layer 0 and 1s open up in terms of the mainnet opening up. And even when they do open, like Solana, they're still in the beta form. So you've got recruitment of developers so they can build your layer 0 and layer 1. Then you've got to build your dApps. So this all takes time. And as I mentioned earlier, the business models are very long. They have long tenures, just like you see in software as a service. So next slide. So this is where it all comes to a fruition. So what are the price to sales ratios? And I mentioned that I would refer to the previous slide on the price to sales ratio for the S&P and the price to sales ratio for cloud companies, which are about 8 to 10. Well, if you look here now, and maybe I should point out what we're looking at. This is from Token Terminal. This is probably one of the few, if not only, places you can get a table of these ratios and numbers and metrics. And if you look on the left side, all the way to the left, obviously is the name of the crypto project. Then you've got the circulating market cap, and I promised you I would use that one. And then you've got the revenue 90 days, and they've got data on everything, 7-day, 30-day. But I like to focus on the revenue for the last year. But it's also important, obviously, given that crypto projects are moving so fast, and you saw big declines in revenue over the last year. It's important to look at like trends. But it's better to look at that on another website like Artemis, or just go to the Explorers. For this case, we're just going to be looking at these simple columns, circulating market cap and revenue over the last year. And if you look on the near the right side, second to last column on the right, and the top, it says price to sales ratio based on circulating market cap. So you can see Ethereum, which has been around a long time, has a price to sales ratio of 92. And then Cardano, which is doing really well now with NFTs, they have not available. Maybe data is not available. It's too early. I don't know. But I know there is revenue on that. And then Polygon, which is doing well, even though it's doing well, it has lots of revenues, right? Its price to sales ratio is pushing 218. And then we got Solana, whose revenues and total value locked crashed after the FTX and Alameda bankruptcy. You saw Solana's price to sales ratio skyrocketed to 900, even though the market cap declined. Remember, the price to sales ratio is a ratio of a numerator and a denominator. And then you've got Avalanche, which is doing well, but that has a price to sales ratio of 66. And then you've got other ones on the bottom that are hitting thousands for the price to sales ratio. So what's my point here? My point is, and I don't need to tell you, you can see it from the table, is that it's too early. The price to sales ratios do not make sense. And one thing I want to mention from before is these are still, and we talked about Jay Ritter, the data from IPOs, initial public offerings, and the data is still, the companies, I should say, are still too young. We've mentioned internet companies that were only 4 years old when they went public. The same thing here. These companies, most of them, had their ICOs in the last few years, beginning, trying to think of when they all went public. I would say beginning, or on average, maybe 2019, 2020, and some of them a lot of them also went public in 2018, but they were like different generations. Some of them went public 2018 and they disappeared. So a lot of the generation 2s and 3s went public more recently. This is like Solana, Near Protocol, Elrond/Multiverse. They changed the name. Of course, there's Sui and Aptos, which just did the ICOs. So these are new blockchains. So it's way too early. So my third point here is other important data will be the number of users, number of transactions, and number of wallets. So let's go to the second point. I looked up some research and I wrote here proof. So from the Financial Analyst Journal, there is proof that internet traffic is related to portfolio returns, meaning the higher traffic to a certain websites, to a certain company's website, the higher the returns. And I mentioned this earlier with IPOs. It's the same thing. So I think using price to sales ratio is going to be very important, especially amongst institutions that are doing fundamental analysis, but it's still too early. So I made this presentation because I think it's important for the next few years, but not now. So right now, I think maybe we should focus more on number of users. And I didn't mention it up here, but total value locked, especially for DeFi, that is important. So we're going to have some videos in the next few months that look at things like total value locked, what's going on in the NFT space, who's doing really well there. So I hope you enjoyed this. Remember, this is a crypto, in my opinion, we're still in a stock and crypto bear market. It's a crypto winter. And everyone is focusing on what's the next bank that's going to shut down. But I think, and which cryptos are going up a lot and crashing, I think now is the time to put your head down and focus on crypto projects because this takes time and we need to be ready. Because when a Fed eventually pivots, and I don't think it's going to be now, but when they pivot, things are going to happen fast. And we need to be ready for that. Well, thank you all for joining us at Lamb's Cryptoverse. Don't forget to like us on the bottom and subscribe to us. And in this way, I can continue making more videos to help you. Thank you. Bye-bye.